Hi, everybody. Scott Riley, August 1st, the Market Update Desk, NMLS 157524. Today, we're going to say the theme is the truth will set you free. Fed Chair Powell, the truth is finally coming through the BLS jobs report, and it shows that you were wrong regarding the employment market. Finally, the BLS is showing us they were full of BS within the massive revisions. Let's break everything down here. We did a quick update this morning. Let's go more in depth. So, all in, the BLS told us that there were 73,000 jobs created last month, weaker than the estimates of the market expectations of 110,000. In fact, the raw figure showed 1.07 million job losses, but they seasonally adjusted it much, much higher. So already some funny things going on. We don't really know how bad this report is, probably for 2 more months. So indicative of this, the birth death model added, get ready for this, 257,000 jobs on a seasonally adjusted basis. Without it, the job growth likely would have been flat or negative. The BLS released their BED or bed report. Now, this revises the previous birth death figures. This is another whopper. This report was for Q4 24. Now, it showed that they revised the birth death model down 170,000 in Q4 of 2024. We've yet to see that for Q1 of 2025, but I'm sure it's going to be massive. And speaking of revisions, that's our popular word whenever we get these BLS reports. The prior 2 months were revised down by a massive combined 258,000 jobs. Exactly what we've been saying. When we got these reports, they were a load of horse manure. They had no sense of reality within them. And now we're seeing that we were right. And so many, just reading the headlines, didn't get it right. May, for example, which was initially reported at 139,000 jobs, was revised up to 144,000 in a previous report. But today's release showed it was revised down by 125,000. What that means is there was only 19,000 jobs reported at the end of the day in May created. The June report initially reported at a very surprising 147,000 jobs and caused a huge sell-off in the bond market, which caused you, the home buyer, to pay a higher rate. Today, they revised it lower by 133,000 jobs. That means there was only 14,000 net jobs created after the revision. And keep in mind, we're not done with revisions to the June report, which could end up, when all things are said and done, at a negative number. Now, when we look at the whole year, 2025, the average revision is a negative 77,000 to each report. Much worse than in previous years. This means that buyers were in January, February, March, April, May, June, July, hit with higher rates than what they should have because of the faulty, bogus, unreliable BLS jobs report. Now, in this current report, they're showing there were 83,000 private sector payrolls, but the majority of this was in the the education and health services area. Additionally, last month's number from there, which we talked about, was way off, was revised much lower. So this report's definitely going to be revised lower. Now, leisure and hospitality, as compared to the ADP, showed that there were only 5,000 jobs created. That makes sense with the slowdown in travel. Healthcare and social services added 73,000, what we just talked about. That's highly likely that's going to get revised down. Now, that's the headline report. There's also the household survey report. This is where unemployment rate comes in and calculated. Let's go into this because it's kind of scary again. Household survey report. This could be a much more realistic number, by the way. It showed there were not job creations, but 260,000 job losses. Yes, losses, not positive. As a result, the unemployment rate rose from 4.1 to 4.2, but that's not the real number. That's the rounded down number. If you looked at the unrounded number, it's 4.248, a whisker away from 4.25, which would have been reported then at 4.3%. This was a continued drop in labor force where they no longer count individuals as unemployed. I'm sorry, the exact figure was 4.428. There was a continued drop in labor force where they no longer count individuals as unemployed or in the labor force. Without it, the unemployment rate would really be about 4.3, 4.4%. The participation rate fell to 62.2%, down 0.5% over the last 10 months and 0.4% in just the last 3 months. So without the funny numbers of having people fall off, we would have had a higher unemployment rate. That means roughly 7 million people have left the labor force in the last 3 months. Now, the U6, which does take into account these people leaving the labor force, as the U3 does not, the unemployment rate jumped 0.2 from 7.7 to 7.9%. That's a more realistic number. When we look at the jobs themselves, we lost 440,000 full-time jobs, and those were replaced by 247,000 part-time jobs. Average hourly earnings rose 0.3%, but the average hours worked did increase by 1/10. So what does this all mean? Remember when Chairman Powell came out and has multiple times talked about the strength of the labor market, and that's why they need to be restrictive and not cut rates. Well, we found out that was a load of bull. We've been talking for months that the employment market is not anywhere near what we're being told or what's being talked about by Chairman Powell. Now remember, he's an attorney, not a trained economist. He has people under him that can easily look at this data, but they're only reading off the headlines and they're interpreting that as policy. maybe the sledgehammer will come through to them and show them finally that the labor market is nowhere near what they interpret it at or were trying to sell us on. Now, Fed Governors Waller and Bowman spoke about the reasons why they dissented on the July 30th meeting. Both wanted a 0.25 point rate cut, and they were probably correctly thinking that. They had similar explanations for that, saying that the Fed needs to look past one-time price increases from tariffs, that the economy is not that strong, averaging only 1.2% growth over the first 2 quarters, and the labor market is significantly weaker than the BLS is stating. And the patterns of revision, and those revisions stressed and emphasized why those two were correct in their statements. Fed Governor Bowman also introduced an interesting new metric she's tracking, which is core PCE inflation. It subtracts out the increase of tariffs. Bowman believes the figure for core PCE is really closer to 2.5% when you factor in a 2 to 3/10 one-time bump for tariffs. And that 2.5% is not far off their goal of the 2%. So the rate cuts needed to have already happened probably 2 meetings ago. Now we're playing from behind, which the Fed loves to do. They love to play from behind, and Chair Powell needs to be able to address this. If the BLS reported accurate figures initially from these BLS reports, we would have only been showing 19,000 for the May report and 14,000 for the June report. That would have had a significant difference in the bond market, which means significant difference in interest rates. Now, today, we're getting a rally. The 10-year Treasury is down 15 basis points. We broke through the 4.32 barrier, and we are butt up against the 4.21 barrier. If we break through that, we've got a line to about 4.12. And then below that is a sub 4. Mortgage-backed securities, broke through their resistance of 101.76. And the next stop is about 33 basis points higher. We're about 34 basis points higher on mortgage-backed securities right now. So, wow, was it a good day? The truth has finally set the market free, and we're seeing some good things. Take advantage of that. Find your house this weekend. We're on call. Get pre-approved. Let's get you locked in. Refinances. Let's look at looking at your global debt, your global interest rate, and set you up for success, saving you tens of thousands of dollars. Give us a call. We'll help analyze that. 616-293-2189. The Market Update Desk, your original singular market news source for West Michigan. Have an awesome weekend.